All right, morning, guys. So today, I I didn't change the title of this slide that I got, but this is a basic presentation going over the Greeks, intrinsic value and extrinsic value. Really dense and difficult topics to understand, but I'm gonna do my best to break everything down for you in a easy to understand fashion. So this is the power of the Greeks. Same thing. Option pricing can be really complex, but we use the Greeks to decode that. They're a really essential tool that can give us like an edge when we're picking a contract. This isn't so much for day trades. This is going to be more for your weeklies or your swing trades. I'm not to say that you can't use it on a weekly, on a daily, but it's just not going to be as effective on a daily as it will be on a larger time frame swing trade. So you might be asking yourself, like, what are the Greeks? I have everything on the screen here, but we'll just kind of go over it. The Greeks truly measure how option prices react to different forces. They help answer questions like, how will my options react to a $1 move in the stock market, or how much value am I losing each day? And you can kind of see that here. Like theta, you'll always hear, especially like me and A-Main who trade daily contracts, we always say, you always hear us talk about theta decay, right? Theta decay is how much value do I lose daily, and for a daily contract, it is always the price that you pay. That is the maximum theta. When it comes to delta, how much will this option move? So for every dollar that the stock goes up, how much is my option going to move? That's how you use delta. What we're not going to go over is rho. We're not going to go over rho. And vega is not as important, but delta, theta, and gamma are pretty important, right? So with that, here's kind of an example. If you've never seen the Greeks, you have no idea what the Greeks are. You might be sitting here thinking, I've seen these little things on the bottom of Robinhood, but I have no idea what they mean, right? So delta, gamma, theta, vega, rho, this is what they look like. And if we go back, you can see, we'll just kind of use this as a little teaching moment. So we'll say delta, right? How much will this option move? Well, this is saying this is a SPY call option, 599 calls for June 27th. Okay. So I added this to our thing yesterday, and it's saying that for every $1 that SPY goes up, this contract is going to go up 49.25 cents. Right? So we'll say this is $4. If SPY goes up $1, this contract will now be $4.50. Does that make sense? And then we can switch over to gamma. Gamma is how fast is the delta changing. You can see that the gamma is very low, 0.0388, right? So it's not moving super fast. Theta, of course, because this was a contract that was added yesterday, you can see that if the stock stayed the exact same value, which we can see right here, SPY is at 598.43, right? If SPY opened at 598.43 and it closed at the end of the day at 598.43, you would still lose 54 cents on that contract. Does that make sense? So even though SPY price did not change, because there is a time value to your contracts, because they do expire, and since you are getting closer to expiration, you are going to lose 54 cents per contract per day. So that's kind of the quick rundown. This is just kind of we're gonna dive a little deeper into it, how you would use it, how you would use each and every Greek to enter a trade. So the purpose, choose how much your option reacts to the stock movement. That's what delta is. If you want a higher delta, you're looking at something that's like 0.6 to 0.8 when you're confident in a short-term direction. Let's say SPY is breaking out, or you're on like the 4-hour chart. You just broke out of a downtrend, right? And you're thinking, okay, this is going to go and it's going to go fast. We have news, we have earnings, things like that. That's how you would want a high delta. If you want a low delta, you want it's like a slow moving, maybe more of like a trend play. Like let's say Amazon's been on a slow grinding trend, but you know that it's working its way in that direction. You would look for something with a lower delta for the best entry. So to go along with that, if you want to ride the momentum, go with a higher delta. If you want a really cheap lotto style trade, go with a lower delta, but you need to understand the risk. When it comes to theta, obviously weekly trades, daily trades for the most are the most affected by theta. And then of course it's weeklies and then monthlies and then leaps, right? So theta is the easiest one to understand. If you want to avoid entering a short-term trade, if the move isn't immediate, because you will get theta decayed, or alternately known as theta clapped. You don't want that to happen. Yeah, and it says target setups that look like they're ready to move today or tomorrow when it comes to theta. If you're just looking at theta, you want to make sure that the move is ready to go in the next few days. Gamma. Gamma is it's the highest on short dated at the money contracts, which means it's going to be very responsive. What this basically means is that closer to in the money, the higher the gamma is going to be, because gamma is how yes, Ty, it should be gamma is sorry, I just gotta double check now. Gotta make sure that it's not. Okay, Clarity says it is. Okay, I just wanted to make sure. As far as gamma goes, it shows how quickly the delta will change in the stock move. So a higher gamma is going to be a higher sensitive stock. You will make money faster if you are right on the direction. It's especially powerful right before a big move or a big catalyst. So think of things like earnings, Fed announcements. Those are both key gamma setups, and you guys see that when it comes to like GEX levels. We have really big GEX levels right before news happens, and then normally it swings one side or the other to get us there. This is one we didn't really talk about before, but this is Vega, and it's how sensitive your option is to change in implied volatility. So we'll go over IV here in just a second, but Vega really just measures how sensitive your option is. It's more relevant during events like CPI, FOMC, earnings, things like that. If you buy low IV, sell high IV, just like buy low, sell high in stocks. You can do the same thing with a low Vega. You can buy a low Vega and sell a high Vega, and you can make money that way. I don't have an IV chart that I could show you around earnings, but like intrinsic value goes crazy right before earnings, and that's because the Vega is rising. So again, this is just kind of putting it all together. So if your goal is you're expecting a fast move, you want to look for a high delta, a high gamma, and you want it to be at the money or in the money weekly contracts if you were expecting a very fast move. If you just want exposure, you just want to be in a trade, you're like, I don't want to miss this move, but I don't want to risk a whole lot. Of course, you're looking for a lower delta and you're looking for cheaper options. Is the volatility low? It's a good time to buy. This is called the Vega edge, right? So you don't, if it's low volatility and the Vega matches, you want to jump into something like that. If you're just sitting and waiting, of course, like if you're in a trade, theta will eat away at your premiums. And then if you're getting close to news, anticipate volatility spikes, and you can use the Vega Gamma to time your entry. So that is the Greeks. Very, very, very high level overview of the Greeks there. Before I jump into intrinsic value, does anybody have any questions about the Greeks? Or is it going to be something more that you have to kind of digest everything that just was said and then come back with questions? Okay, we'll keep moving then. Let's move on to intrinsic value. So otherwise known as IV, intrinsic value. Intrinsic value is the real in the money portion of the option price. Again, I don't want to do death by PowerPoint, but it does answer the question: if the option expired today, what would it be worth? Okay, this only applies to options that are in the money. Okay, it's never a negative number. If it's not in the money, the intrinsic value is 0. It is based purely on the relationship between the stock price and the strike price. Here's a small example. Okay, if the stock price is $120 and you bought a contract that is a $100 strike price, this takes the idea of premiums completely out of it. Okay, so if the value of the stock is 120 and you bought at 100, the intrinsic value of that option is $20, because if it expired today, it would still be worth $20, right? On the put side, same thing. Strike price of, if the stock is $85 and you bought a put at $100, the intrinsic value is $15. Okay, out of the money options have a $0 intrinsic value. The more intrinsic value, the less you're relying on future price moves or time. And in the money is typically means more expensive, but they're way safer as far as contracts goes. If you're looking at weeklies, or leaps, things like that. But if you want to be like if you want a cheaper contract and you want it to be a little riskier, you're looking for something that is out of the money. And you can use this to pick your strike based on your risk tolerance and your setup. So keep that in mind. This is kind of why it matters. I don't want to get too deep into it. You can look at it there. I mean, it's kind of that same idea. It determines how safe an option is. The deeper in the money you are, the safer it is. Like, I guess one way to put it is like, let's say we were like SPY went up over 600 today. Let's say we opened at 605, right? If I would have bought $600 calls, no matter what, I knew they would be worth at least $5, right? Because we were at 605 and we continued to go up. But I gave myself more of a buffer to where if it did come down, let's say it went down from 605 all the way down to 603. Okay, well, then those are still worth $300 versus like $500 that you started with. Does that make sense? So, obviously, just in the money is higher IV. They cost more, but it moves with the stock. And then out of the money is they are cheaper, but they do depend on more timing and direction. And if you've been following me for a little while, you know that I like to play as close to in the money as I can while still being slightly out of the money. I won't normally buy an in the money stock unless it's just dirt cheap. But you'll never catch me buying something that's like $5, $6, $7 out of the money just because they're $2, So, and then intrinsic versus extrinsic value in pricing. So, I actually don't know if I finished this slide, but I will see. I didn't. Okay, let me see. I have it typed out right here. Let me grab it. Where did it go? I had another example that I was going to share with you guys, kind of a way to go over. Let's see. It was like a little calculation. I'll put it on a notepad. Okay. So this is kind of the idea here. When it comes to like putting everything all together and kind of doing the math, and it's really hard to do this on the fly, so don't really worry about it in that matter. But this kind of goes with everything. So if our stock price is 110, that's how much the stock is, and the strike price for the option we are buying is $100. Don't tell me how, but our option costs $5 in premium. Right? That doesn't make any sense, but it's fine. It's just an example, right? So we are paying $500 for a 100 strike for a stock that is already $110. Okay? So our intrinsic value is $10 because we are already $10 over the strike price. Okay? Intrinsic. The extrinsic value is the $5 that we paid minus the $10 intrinsic value, and that gives us a negative $5 extrinsic value. It's the actual premium must be higher. Okay, so that's why it doesn't make sense. So now if we use $13 as our premium, so we are now paying $1,300 for a contract, that means our intrinsic value is still $10, okay, because it's $10 over the strike, but our extrinsic value is $3. Does that make sense? I'm not showing Notepad. Okay, 2 seconds. I can fix that. Why did it not? Entire screen. Go here. Now, can you see Notepad? You should be able to see it now. Okay. We'll run back over it. This top part doesn't really matter anyway. Well, this middle part doesn't matter. Let's just do this and change this to 13 because that's where we were at. And this makes more sense anyway. Okay. So call option is $13 premium. So we know we're paying $1,300 for this premium. Right? It could be months out, could be days out, could be, whatever, right? $1,300 for that premium. We are currently in the money because our strike is 100, our stock price is 110. We are obviously expecting it to go to at least 113 to make our money, right? But our intrinsic value is $10, right? Our extrinsic value, which is what we're betting on, this is the true, what I would call premium that we paid for the contract, is $3. Okay, so if our theta is 0.08, which means, why did I pick such dumb numbers? I'll just put 1.00. Okay. That'll be perfect. Okay, so if our theta is -1, we lose $1 per day up until the day of expiration, no matter what, right? So if it's $1,300 premium today, if nothing changes, tomorrow it'll be $12.99. The day after, it'll be $12.98, and that's if the stock doesn't move at all. Okay, and then you find your other value right here called delta. So if our delta is plus 0.65, every dollar that the stock goes up, we only make 65 cents. Okay, so when I said we were trying to get to 113, what would that come out to, right? So even if the stock went up to 113. So if we went from 110, if we went from 110 to 113 with a 0.65 delta, that would only be, let's see, that would only put us at, if we went up $3 on the stock, that would only raise our contracts by 1.95. So even if we were at the money at 113, we would still be down on our investment because it would only come out to 1.95 because we only have a 0.65 delta. So what that tells us with the information that we learned before, if we go back to delta, is that this must have been a lower delta. So this is something that we were going to kind of grind out. We were going to sit on this position for a long time. It must have been a cheaper contract with more leverage. So that is where we are at with the Greeks, with IV and a little bit of EV. Extrinsic value is just really straightforward. And I hate to say it like this, but extrinsic value is everything that isn't intrinsic, right? It's mainly time and volatility. So I always use me and A-Main as an example because we trade daily contracts. We are almost extensively extrinsic value traders, me and A-Main, because we try to catch the move. We try to ride contracts very quickly, right? It's all about timing and it's all about volatility. And it's extrinsic is what you could lose as time passes or if volatility drops. And we've seen that. Me and A-Main will play a breakout and then like it goes flat for 20 minutes and then our contracts are down because the volatility is gone, right? Extrinsic value just means that you're paying for potential and you're not guaranteed anything. So, anywho, with that being said, is there anything you guys want to ask? Like I said, I know it's kind of dense, and there's probably a lot of different things that we could go over, but I was doing my best to keep it relatively short. We still spent 25 minutes talking about this, so that's long in itself. But I am more than willing. I have the rest of the day to go over any questions you guys have. So just let me know. I will go ahead and stop the recording for anybody listening, and then I will restart if a question comes up. So if there are no questions, thank you guys, and I do appreciate you guys stopping by today.